Hi, I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. Earlier this week, Woolworths released a trading update that outlined a planned restructuring of the underperforming Big W brand as a result of a weaker than expected turnaround in the business. Losses in this current financial year are only expected to be marginally lower than the $110 million loss reported last year. However, this news was largely ignored by the market due to the announcement of an off-market buyback as the company returns the $1.7 billion received from the sale of its petrol business. The decision to return capital to shareholders in this manner is no doubt in part due to the stated Labor Party policy to eliminate cash tax refunds on franking credits paid to low income and tax-exempt investors. Off-market buybacks are a very efficient means of paying out franking credits, as only those shareholders that can utilise the tax benefits will participate in the buyback. Those that cannot utilise the tax benefit, mainly overseas shareholders, still get a benefit as the company is effectively able to repurchase the shares at a cash price that is well below the current market price. The structure of the buyback is such that the first $4.79 per share of the price will be deemed to be the capital component of the price received for capital gains tax purposes, with the rest of the cash price paid being a fully franked dividend. Shareholders are invited to tender their shares into a reverse auction, with Woolworths setting the price range between $25.80 and $27 per share. This would equate to the capital component of $4.79 per share, plus a fully franked dividend of between $21.01 and $22.21 per share. The after-tax value of the price range depends on the tax circumstances of the individual shareholder, with those paying a lower rate of tax on their income receiving the greatest after-tax benefit. For example, based on a final tender price of $25.80 and a shareholder that bought their shares for $25 originally, the after-tax value of selling into the buyback for a super fund paying a 15% tax rate would be $31.90 per share. While an individual holding the shares and paying a marginal tax rate of 47% would only realise after-tax proceeds of $24.48 per share. This is due to the refund of franking credits in excess of the tax payable on the dividend by the super fund investor. One of the key assumptions is that the shareholder is able to utilise any capital losses created by selling into the buyback. This will depend on the individual shareholder's original acquisition price and whether they can realise capital gains on other investments in the current tax year. The additional $6.10 of estimated after-tax value generated by the super fund shareholder relative to the $25.80 of cash paid by Woolworths is entirely due to the refund of franking credits and the discounted capital gains tax rate on investments held for more than a year. Both of these benefits will be either eliminated or reduced under a Labor government. As such, off-market buybacks will become largely ineffective as a means of returning capital in tax-efficient manner. Given the current polling for the upcoming federal election, it is not surprising that there have been several companies announcing special dividends and off-market buybacks in the last few months. The Woolworths announcements has seen it join BHP, Rio Tinto and Caltex in streaming excess franking credit balances to shareholders. More companies are likely to announce capital management initiatives in the coming months. That's all for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.